I want you to understand something that most investors are still missing. The next big AI trade may not be the chip. It may not be the model. It may not even be the software. It may be the electricity. That sounds simple, but it is one of those simple ideas that changes the way you see the whole system. For the last few years, investors have watched artificial intelligence through the most obvious window. They watched NVIDIA, they watched semiconductors, they watched cloud companies, they watched software, they watched the companies building the visible layer of the AI boom. But underneath all of that is a physical constraint. AI does not run on excitement, it does not run on headlines, it does not run on analyst reports, it runs on power, and the American power grid was not designed for the kind of demand now being placed on it. That is where the real story begins. The public story is that AI is a technology revolution. The structural story is that AI is becoming an energy crisis. And when a technology revolution collides with an energy constraint, capital does not disappear. It rotates. It moves from the obvious winners to the bottlenecks. It moves from the layer everyone is watching to the layer that must be fixed for the whole system to keep growing. That is why the power grid matters. If you cannot power the data centers, you cannot scale the models. If you cannot scale the models, you cannot justify the capital spending. If you cannot justify the capital spending, the AI story breaks. So the grid is not a side issue, it is a central constraint. And when a constraint becomes central, money flows towards solving it. That is the principle: follow the constraint, follow the money. Most individual investors follow the narrative after it becomes obvious. They wait until the headlines tell them what is already happening. They wait until television explains it. They wait until everyone around them has heard the same story. Institutional investors behave differently. They watch capital flows, they watch contracts, they watch backlogs, they watch where real spending is already moving before the story becomes mainstream. That difference matters. A story can be wrong, a forecast can be wrong, a headline can be late, but money already committed to infrastructure, signed contracts, government programs, and corporate spending is much harder to dismiss. That is why this opportunity has to be understood as a system, not a stock tip. The system is this. AI data centers are consuming enormous amounts of electricity. Demand is growing much faster than the grid was built to handle. A large share of transformers and transmission infrastructure is old. Data centers cannot wait 5 to 10 years for normal grid approvals. The government is stepping in because grid reliability has become strategically important. Private companies are building their own power solutions because waiting is not an option, and capital is flowing into the companies that build, supply, cool, connect, and power that infrastructure. That is the chain. Once you see the chain, the investment picture becomes clearer. This is not simply about buying whatever company has gone up recently. That is not how I think. The question is not what already moved. The question is what structural demand is being created, which companies have evidence of participation in that demand, and which parts of the supply chain are most difficult to replace. That is a much better framework. Let us begin with the underlying pressure. America's power grid was built for a very different economy. It was designed around homes, factories, office buildings, refrigerators, air conditioners, and the normal industrial and consumer loads of the 20th century. It was not designed for AI supercomputers running continuously at massive scale. A data center does not sleep. It does not reduce demand at night the way a household does. It cannot simply shut down when the wind is not blowing or when there is a delay in grid capacity. These facilities require dependable power all the time, and as the AI build-out accelerates, the demand for electricity rises with it. The source document makes the point very aggressively. AI data centers now require power on the scale of tens of millions of American homes, and by 2030, that demand could more than double. Whether the exact figures change over time, the direction is clear. The demand curve is rising fast. At the same time, much of the grid infrastructure is old. Transformers are aging, transmission lines are old, substations need upgrades. Permitting is slow, utility planning cycles are slow. The grid is not a startup. It cannot scale in a few quarters. That mismatch creates the opportunity. Technology demand is moving at software speed. Power infrastructure moves at physical world speed. Whenever one part of a system moves faster than another, the slower part becomes the bottleneck, and the bottleneck captures capital. This is why data centers are increasingly looking beyond the traditional grid. They are not simply waiting for utilities to solve the problem. They are building or contracting for dedicated power fuel cells, natural gas generation, small modular nuclear private power purchase agreements, on-site generation cooling systems, transmission upgrades, switchgear, power conversion, electrical contracting materials. This is the hidden supply chain underneath AI. It is less glamorous than the model layer, but it may be more necessary. In a gold rush, not every miner wins, but the people selling the picks, shovels, rail lines, water tools, and infrastructure can do very well. The same principle applies here. The AI gold rush needs an energy supply chain. That is why the policy shift matters. The source document describes an executive order focused on strengthening grid reliability and security. The exact political label is less important than the function. The government is recognizing that the grid is no longer simply a utility issue. It is a national competitiveness issue. It is a defense issue. It is a technology issue. It is an industrial policy issue. When the government begins treating a bottleneck as strategic, the capital environment changes. Permitting may accelerate, emergency authority may expand. Older power plants may be kept online longer. Critical facilities may get priority. Long-term power purchase agreements may be encouraged or accelerated. Transmission funding may increase. The important thing is not only the order itself, the important thing is what it signals. It signals that power reliability has moved from background infrastructure to frontline economic policy. And when something becomes policy, capital tends to follow. There is a phrase I learned early in studying markets that remains useful. Do not listen only to what people say, watch where the money goes. If there is real money behind a theme, it leaves tracks. Stock performance is one track. Backlogs are another. Contracts are another, government appropriations are another, capital expenditure plans are another, supply shortages are another. When several of these tracks line up, the theme becomes more than a story. The source document points out that while the broad market was relatively flat over a recent period, several power-related sectors were rising sharply. Power line construction, engineering and construction, electronic components. Energy infrastructure, companies tied to data center power and grid equipment, that is what rotation looks like. It does not mean every stock in the theme is cheap. It does not mean every company will win. It does not mean there will be no pullbacks. But it does mean the market is starting to price a structural shift before the average investor fully understands it. The mistake many people make is thinking they must be first. They want to buy before anyone sees the theme. They think early is always better. That is not always true. Being too early can be dangerous. You can be right about a long-term trend and still lose money because the market is not ready. The company is not ready. The balance sheet is weak or the contracts are not there. Often the better point is not the earliest point. It is the point when evidence begins to confirm the thesis but before the theme is fully saturated. I would rather be a little late to something real than very early to something that never becomes real. That is a very important investing principle. A little late can reduce risk if the evidence is stronger. Too late can be dangerous if valuation becomes extreme. So the skill is not to be early for the sake of being early. The skill is to recognize when the evidence has improved and the crowd has not fully caught up backlogs. Help with that. A backlog is work the company has already sold. It is not a press release about what might happen someday. It is not a vague forecast. It is not a dream. It is contracted or committed work that should become revenue over time. That is why backlogs matter so much in infrastructure cycles. When a company has a very large backlog, it tells you that demand is not theoretical. Customers have already committed. The source document uses Quanta Services as a key example, noting a very large backlog tied to grid infrastructure work. Whether one uses that specific company or the broader idea, the principle is the same. In infrastructure, backlog is a kind of visibility. It does not eliminate risk. Margins can change, costs can rise, execution can fail, contracts can be delayed, but backlog is still much more concrete than a story. If you are studying this theme, you should care less about who has the most exciting language and more about who has signed work, customer demand, and capacity to execute. Now let us think through the main areas where the money can flow. The first area is off-grid or dedicated power generation. This is one of the most important shifts. If a data center has to wait 5 to 10 years for grid connection, that delay can destroy the economics of the project. AI capacity is needed now, cloud demand is now, competitive pressure is now, so large companies are not waiting passively. They are securing power directly. That can mean on-site generation, that can mean fuel cells, that can mean gas turbines, that can mean nuclear agreements, that can mean long-term power purchase contracts. The key idea is that private companies are beginning to behave like partial utilities because the traditional utility process is too slow for the AI cycle. That is unusual. When the largest technology companies start building their own energy strategies, it tells you that the bottleneck is serious. Bloom Energy appears in the source document as a company tied to fuel cells and on-site generation. The idea is that fuel cells can sit near the data center and provide electricity without depending fully on the grid connection. This is not a recommendation. It is an example of the kind of business model that fits the bottleneck. The question to ask is simple. Does the company provide power where and when the grid cannot deliver fast enough? If yes, it is part of the problem-solving layer. Then there is nuclear. Small modular reactors are becoming part of the discussion because large data centers need dependable baseload power, and technology companies also want to claim lower carbon energy sources. Nuclear has long permitting, political, safety, and execution challenges. It is not simple, but it has one feature that intermittent renewables do not have. It can provide continuous power. That is why the AI power problem has revived interest in nuclear. The source document mentions companies connected to small modular reactors and uranium supply. Again, the deeper principle matters more than any single ticker. If nuclear demand rises, then the supply chain matters, reactor developers matter, fuel suppliers matter, uranium producers matter, engineering firms matter, regulation matters, timelines matter. Investors must understand that nuclear is not a quick trade in the same way as a software cycle. It is a long cycle infrastructure theme with political, technical, and financing risks. But if the demand becomes real and persistent, the supply chain can reprice over time. That is how long cycle themes work. The second area is the physical grid builders. These are the companies that do the unglamorous work: transmission lines, substations, utility construction, power corridors, large-scale electrical infrastructure. This is not the part of the story that attracts casual investors first because it does not sound like the future. It sounds like wires, poles, transformers, and construction crews. But the future cannot arrive without the wires. That is why these companies matter. Quanta Services is one example in the source document. Mastech is another. Argon is another. Comfort Systems appears as a contractor tied to mechanical and electrical systems for data centers. The companies differ, but the common idea is this: if the grid must be rebuilt, expanded, hardened, and connected to new demand centers, the builders get work. The work may not be as exciting as AI software, but it may be more predictable if contracts and backlogs are strong. That is the kind of thing institutional money often likes. Not because it is dramatic, because it is visible. The third area is the components layer. This may be the pick and shovel layer beneath the pick and shovel layer. Every data center, substation, and grid upgrade requires specialized equipment: power modules, switchgear, circuit boards, transformers, cooling systems, electrical distribution equipment, thermal management, power conversion. These are not optional. If electricity must be generated, converted, distributed, managed, and cooled, the component suppliers become important. This is where companies like Viker Powell Industries, Vertiv TTM Technologies, and advanced energy-type businesses appear in the source document. The point is not to memorize a list. The point is to understand where the constraint moves. If chips consume huge amounts of power, then power conversion matters. If data centers produce enormous heat, cooling matters. If substations must handle higher loads, switchgear matters. If transmission must expand, transformers and conductors matter. If hardware becomes more power dense, electrical reliability matters. Every bottleneck has a supplier. The investor's job is to identify which supplier has pricing power, capacity, backlog, technical differentiation, and balance sheet strength. That is where the analysis begins. The fourth area is raw materials. You cannot build a grid out of slogans. You need physical inputs: copper, aluminum, uranium if nuclear expands, steel and certain structures, specialized metals and components. The more infrastructure is built, the more material demand rises. This does not mean every commodity producer is a good investment. Commodities are cyclical, they can be volatile. Supply can respond, prices can move for reasons unrelated to the specific theme, but when a policy-driven build-out meets tight supply, materials can become part of the investment map. The source document discusses aluminum and points to the idea that domestic producers may benefit if policy favors American materials or tariffs restrict foreign supply. That is a classic industrial policy dynamic. When government spending, strategic supply chains, and tariffs interact, domestic producers can gain pricing power or demand visibility, but investors must be careful. Commodity stocks can run far ahead of fundamentals. A stock already up several 100% may have priced in a lot of good news. Sometimes there is still more to go. Sometimes the risk-reward has changed. So the framework must be disciplined. Do not buy because the chart went up. Ask why it went up. Ask whether the earnings power has changed. Ask whether the backlog, pricing, supply, demand balance, and policy environment support more growth. Ask what happens if the cycle turns. The fifth area is the broader capital rotation. This is not exactly a sector, it is a behavior. Capital moves in waves. At one stage, money crowds into the obvious AI leaders. Then, when those become expensive or the next constraint becomes visible, money rotates into infrastructure. Then it may rotate into energy, then components, then materials, then contractors, then second-order suppliers. This is how themes mature. The first wave is narrative. The second wave is infrastructure. The third wave is supply chain. The fourth wave is capacity expansion. The fifth wave is overinvestment risk. If you understand where you are in that sequence, you have a better chance of avoiding both the early uncertainty and the late mania. The source document's framework is useful because it forces the investor to move from story to evidence. Start by zooming out, identify a massive trend that is already happening at a scale too large to ignore. Not something that might happen, not something that depends on a fantasy, something visible. In this case, AI electricity demand is visible. Data center build-out is visible, grid age is visible, government involvement is visible, corporate power procurement is visible. Then ask who benefits, not who talks about the trend, who gets paid when the trend continues. That distinction is essential. A company may use the language of AI, power, security, or infrastructure, but if it does not receive real revenue from the build-out, it may simply be borrowing the theme. The beneficiaries are the companies with products, services, assets, or contracts directly tied to the spending. Then look for evidence, backlogs, signed contracts, revenue growth, margin expansion, capacity utilization, customer concentration, government awards, utility spending plans, capital expenditures. These are more important than commentary. News is often late, the data is often public earlier. The problem is that most people are watching the wrong screens. They watch opinions, they watch price targets, they watch social media, they watch political arguments. Institutional investors watch flows, contracts, and positioning. This is one reason retail investors often feel late. They are waiting for the story to be told to them instead of learning how to read the evidence themselves. The evidence is not hidden. It is often in quarterly reports, backlog disclosures, contract announcements, sector performance, commodity pricing, government documents, and capital spending plans, but it takes work. And most people do not want to do that work. They want someone to tell them what to buy. That is dangerous. If you do not understand why you own something, you will not know whether to hold it, add to it, reduce it, or exit it when conditions change. That is why the goal should be to learn the system, not memorize the tickers. Tickers change, systems repeat. Now, we need to discuss risk. Any theme that has already moved can correct sharply. A stock up 100% or 200% can fall 30 or 40% without the long-term thesis being dead. Valuation matters. Execution matters, interest rates matter, market liquidity matters, customer concentration matters, political changes matter, contract timing matters, supply chain problems matter. If you buy without risk management, a good theme can still hurt you. This is why position sizing is critical. A strong theme does not justify reckless concentration. Diversification still matters. Cash reserves still matter, time horizon matters. Understanding your own temperament matters. If you cannot handle volatility, do not pretend you can because the story sounds exciting. The grid build-out may be real, but stocks tied to it can still be volatile. The market does not reward certainty because certainty rarely exists. It rewards people who can evaluate probabilities better than the crowd and survive the uncertainty long enough for the thesis to play out. That is a very different mindset. I would also be careful with political framing. Some investors get trapped by whether they like or dislike the politician attached to a policy. That is usually not useful. Markets care about cash flows. If a policy redirects money into an industry, your political opinion does not change the fact that companies may receive contracts. You can dislike the policy and still understand the investment implications. You can like the policy and still overpay for the stocks. Keep those things separate. Emotions about politics are not a valuation model. The same applies to energy preferences. Some investors want only clean energy. Others prefer fossil fuels. Others like nuclear. Others dislike nuclear. Those views may matter ethically or personally, but the system needs reliable power. Data centers need electricity 24 hours a day. If the grid cannot provide it, companies will find whatever mix of power is available, scalable, financeable, and acceptable. Under policy constraints, the market will likely use a mix: gas, nuclear, fuel cells, renewables, plus storage, grid upgrades, transmission, efficiency, cooling. The winners may not be the purest ideological choices. They may be the companies that solve the real constraint. Reality is the machine. Investors who impose their preferred narrative on reality often lose. Investors who study reality and adapt have a better chance. The most important reality here is that AI is becoming physical. For a long time, technology investors could think mostly in digital terms: software margins, cloud scaling, network effects, chips, data. But the next layer is physical infrastructure: land power, water cooling, permits, transformers, substations, metals, construction labor, long-term contracts. The AI economy is meeting the physical economy, and the physical economy moves slowly. That slowness creates scarcity. Scarcity can create pricing power. Pricing power can create earnings growth. Earnings growth can create investment returns if valuation is not excessive. That is the chain. This is why I do not view the grid trade as separate from AI. It is AI's infrastructure layer. If you believe AI demand continues, then you must ask what must be built for that demand to be served. Power is one answer. Cooling is another. Data center construction is another. Semiconductor manufacturing is another. Networking is another. Memory is another. The best investment opportunities often appear when the market is still focused on the obvious answer and has not fully priced the enabling answer. NVIDIA was obvious once the chip bottleneck became clear. The question now is where the next bottlenecks are. Power may be one of them. If power is the bottleneck, then the beneficiaries are not only the AI leaders, they are the companies that make power available, reliable, and usable. That is the thesis. Now let me bring it into a simple mental model. Every economic boom has three layers: the visible product, the infrastructure that supports the product, the inputs that support the infrastructure. Most people invest in the visible product. Better investors also study the infrastructure. The best investors often understand the inputs before the crowd does. In the AI boom, The visible product is artificial intelligence. The infrastructure includes data centers, power generation, grid expansion, cooling, networking, and semiconductors. The inputs include electricity, transformers, switchgear, copper, aluminum, uranium, specialized components, and skilled construction. If money flows into the visible product but the infrastructure cannot keep up, the infrastructure becomes the opportunity. That is what may be happening now. This does not mean buy everything in the theme. It means build a watch list, study backlogs, compare valuations, look at balance sheets, look at revenue concentration, look at margins, look at free cash flow, look at insider behavior, look at customer quality, look at whether the company is a true beneficiary or merely using the right words, then wait for opportunities. A theme can be right and a price can be wrong. That is one of the most important investing principles. Do not confuse a good story with a good entry. There will be pullbacks, there will be volatility, there will be earnings disappointments, there will be moments when the market overreacts. A disciplined investor prepares before those moments. The undisciplined investor hears the story after a big move and buys emotionally. The disciplined investor understands the system, knows the companies, and waits for the odds to become favorable. That is how you convert information into process. The source document emphasizes that there are opportunities in every market environment. That is true in a certain sense. The broad index may be flat while subsectors move powerfully. Money does not leave the world, it rotates. But rotation is not random. It follows pressure, it follows spending, it follows scarcity, it follows policy, it follows earnings, revisions, it follows institutional positioning. If you can identify where the pressure is building, you may find opportunity even when the broad market looks uninteresting. That does not mean you should abandon index investing. For many people, a broad diversified core remains sensible. But around that core, if you are doing active research, you must understand rotation. The S&P 500 can be up only a small amount while power, infrastructure, components, or materials move dramatically. That difference is the opportunity and the risk opportunity, because the theme can outperform risk because thematic concentration can reverse quickly. So again, process matters. The broad lesson is not that one stock or one sector is guaranteed. The lesson is that the market rewards those who understand second-order consequences. First-order thinking says AI means chips. Second-order thinking says chips mean data centers. Third-order thinking says data centers mean power. Fourth-order thinking says power means grid equipment, generation, cooling, transmission, materials, and contractors. Most investors stop at the first order. That is why deeper thinking can create edge. Cause and effect relationships matter. This is a cause and effect chain. AI demand causes data center expansion. Data center expansion causes power demand. Power demand reveals grid constraints. Grid constraints cause private generation and public investment. Public investment and private generation create demand for builders, components, materials, and power suppliers. Those companies may see backlogs and earnings improve. If the market underestimates that improvement, prices can move. That is the logic. Now, the other side, what could go wrong? AI demand could slow, capital spending could be delayed, regulation could change. Interest rates could remain high and pressure infrastructure valuations. Commodity prices could reverse, companies could fail to execute, margins could be squeezed by labor and material costs, a political shift could alter funding priorities, stock prices could already reflect too much optimism. A recession could hit demand and multiples. These risks are real. Any serious analysis includes them. The goal is not to pretend the trade is risk-free. The goal is to decide whether the probabilities and price are favorable. That is what investing is, a probability exercise under uncertainty. If someone tells you this is guaranteed, walk away. If someone tells you the theme is impossible because it has already moved, also be careful. Big structural themes can run much longer than people think. The truth is usually more nuanced. The opportunity may be real, but entries matter. The companies may benefit, but not equally. The sector may grow, but valuation matters. The government may spend, but execution takes time. That nuance is where good decisions live. So what would I do intellectually with this theme? I would not start by buying, I would start by mapping the system. Which companies generate power near data centers? Which companies build transmission and substations? Which companies provide switchgear, power conversion, cooling, and electrical components? Which materials are required? Which companies have visible backlogs which have already re-rated, which still have reasonable valuation relative to earnings growth, which have customer concentration risk, which are profitable, which are speculative, which are balance sheet strong, which are dependent on a single contract, which are true toll collectors? Then I would watch for confirmation, backlog growth, margin stability, new contracts, management commentary, government funding releases, utility capex plans, data center expansion announcements, power purchase agreements. If the evidence keeps improving and the valuation offers a margin of safety, then the idea becomes actionable. That is a disciplined process. It is very different from buying a stock because a video mentioned it. The deeper objective is to become the kind of investor who can see these structures independently. You do not want to be dependent on a creator, an analyst, or a headline. You want to understand how to identify capital flows yourself. That is how you stop being late to every major theme. The grid opportunity is a useful case study because the information is public. The executive order is public. Company backlogs are public. Stock charts are public. Quarterly reports are public. Government programs are public. The issue is not that information is unavailable. The issue is that most people are not trained to connect it. They see a headline about AI. They see a headline about energy. They see a chart of a construction company. They see a government program. They see a data center announcement, but they do not connect them into one system. Investing is often about connecting public facts before the crowd connects them. That is what follow the money means. It is not mystical. It is not secret. It is not conspiracy. It is simply disciplined observation. Where is capital being committed? Who is receiving it? Who has capacity? Who has pricing power? Who has contract visibility? Who is essential? Who is replaceable? Who is already priced for perfection? Who is still misunderstood? Those questions create a framework. Now, let us close with a broader lesson. The AI boom is not just a technology story, it is becoming an infrastructure story. America's grid is old. AI demand is rising. Data centers need constant power. Government policy is moving toward grid reliability and security. Private companies are securing their own power sources. Institutional money has already begun rotating into the companies that build, supply, and enable this system. That does not mean everyone should chase the stocks that have already gone up. It means the theme deserves serious study, because the biggest opportunities often arise when a necessary but ignored layer of the economy suddenly becomes visible. Power has been ignored for years because it was boring. Boring can become valuable when it becomes scarce. The old grid was background. The new grid may become one of the central investment battlegrounds of the AI era. And when something moves from background to bottleneck, money follows. The investor who sees that early enough, studies it deeply enough, and manages risk carefully enough may be able to profit from the shift. The investor who only follows headlines may arrive after the best opportunities have already moved. That is the difference. Do not simply watch the AI story. Watch what AI requires. Do not simply watch the companies everyone talks about. Watch the companies they must pay. Do not simply watch the narrative. Watch the contracts. Do not simply watch the market index. Watch the rotation underneath it. That is how you understand the machine. And in markets, the person who understands the machine has a better chance than the person who only reacts to the noise.